Hi, welcome back to another episode of Wilkin and Gutton Plans, the Balance Sheet Breakdown. On today's episode, we're going to be talking through the basic financial statements, what can be learned from each one, and how you can leverage the information from this financial statements to learn a bit more about the financial health of a company. I'm Chris Frederick, a partner with the firm, and joining me today is the head of our QC and the recent new president of the NJCPA, June Toth. So June, first, congrats on the new spot.
Thank you.
That's maybe new from June for all of us. And so obviously, second, thanks for joining on the podcast this month.
Thank you for having me.
And so, I think a bit about maybe the format and maybe the goals of today. We'll talk through each of maybe what the basic financial statements are, what maybe we can learn from each one, and then some takeaways and some ways to maybe leverage that information to get a better understanding of what companies look like.
Sounds good.
So we'll start with the balance sheet. So June, when I think of balance sheet, right, that's kind of the point in time statement. But what is it? What's on it? What can be learned from it?
So it is a snapshot in time. And when speaking with individuals, I'll use an analogy. Think of your balance sheet as almost like when you have your house. It's your asset, your liability is your mortgage, and the equity is what you have left into it, right? So your assets made up of current assets, which are your cash, your accounts receivable, inventory, things that can be converted into cash quickly. Then you have non-current assets, which would be plant, property, equipment, intangible assets like goodwill. It could be franchises or other types of things, licenses, and of that nature. The liabilities, current liabilities, that's any type of debt that is due within 12 months or less. Long-term liabilities, that's greater than 12 months. Deferred tax liabilities, deferred revenue, which is revenue that is yet to be earned that you may have received in advance. And then we have equity, right, or also known as net assets in the nonprofit world, and that represents common stock and retained earnings of the entity.
I think you hit it, and I've never heard the think of it like your house analogy, but that really is it, right? There's really chunks that everybody can kind of easily relate to. You've got your asset, you've got your obligation, and hey, there's some net difference. Hopefully it's positive, but it's not always.
Correct. So there's some clients over the years that are not that financially sophisticated. So I find the easiest way to relate to them and explain to them the financial statements is to break it down into forms that they can absorb and they can relate to.
Yep. Right. It makes it very, like you said, relatable. It's, hey, I've got that. Makes plain English sense to me. When you start talking about things like goodwill, it becomes ambiguous and you lose people quickly.
Right, and they don't understand what are intangibles if you're going to sell a business.
Yep.
It's client lists, right? Your organization's telephone number, the website.
Yep.
All of those things, they exist, but they're intangible. So sometimes it's hard for business owners to wrap their hands around that when either they're buying or selling a business.
Right. It's like you said, it's easier to the property, plant, the buildings, the inventory, the cash. It's
It's concrete. They can touch it. They can see it.
Yep.
They can touch it. But all the other things like the business name, that's hard to wrap their hand around. How is that an asset that I'm buying or I'm selling?
Right, 100%. And so I think that's a good kind of summation of the balance sheet. That's that point in time. That's, hey, with what we've got today, tomorrow's going to be different. Yesterday was different. That's today. Maybe the exact 180 of that's the income statement. Statement of operations, statement of income and loss. It's got a dozen names, right? But kind of at the end of the day, it's that the picture of what your organization did for that, say the last 12-month period.
Right. The income statement is actually showing the performance, what you did, right? How revenue is transformed into either net income or a net loss. And it's composed of several different things. So your top line is revenue, which could be sales. And then it's reduced by cost of goods sold. And those costs of goods sold are direct costs that are attributable to those sales, which gives you then gross profit. And that's revenue minus or reducing it by cost of goods sold. So the revenue, again, as you said, it has many different names, but ultimately consists of the same thing. What are you getting paid for, right?
Yep.
For the services that you provide or the goods that you sell.
Yeah, and I mean, I think this, to me, the P&L always told a much deeper story, right? Because on the balance sheet, hey, it's that kind of snapshot. It's what you've got. Where what I consider 3 rows down of what is a 10-row income statement, and I think there's already some interesting numbers that are popping up, right? It's hey, what did I sell, that kind of top line, and then what's my gross profit? How much did I get to keep of what I sold before I think about all the back office stuff? And so, to me, the profit and loss statement, the income statement, really has a lot on it.
It does, and it's critical to understand it, because after income and cost of goods sold and gross profit, that's followed by operating expenses, and those are often broken up into areas such as selling, general, and administrative expenses, research and development, because those are the key areas that you really want to focus on. Your lenders are going to focus on that too,
Yep.
to see those performances and ratios. And then you have other income and other expenses, and that can consist of, taxes, interest, non-operating items. So then finally that gets you to net income, and that's your total profit after expenses are reduce gross income.
Right. So it's I got my gross income, what did I earn, and I've got my net income, what did I keep?
Correct.
And so and to your point, there's that kind of roadmap all throughout the middle.
Exactly. And then, we as business advisors and as banks, they look to see what are the relationships between that gross revenue and the cost of goods sold and the expenses, because that's where it tells a story.
Right. And like you mentioned, sales expenses, right? So looking at sales expenses as a percentage of revenue means something, and there's ways to correlate that to maybe suggest, are you in line with peers or are you not, and really start to this is, I think, to me, is where you really start to get a deeper understanding of what's really going on and how the company's doing.
Correct, because you can see your cost of goods sold. Does that, is that increasing or decreasing in line with gross revenue
Yep.
and some other expenses? What's the relationship between those line items?
Right, and if they're not going the same direction, if they're going opposite, good or bad, that to me starts to tell a story. Are you able to leverage your skills? Are you able to get better margins from what you're selling? Or conversely, is it going the other way? Is your cost to acquire whatever it is that you're selling, even if it's people costs, going up at a rate which you can't pass through your customers, and the company's getting squeezed out there in the middle?
Right, and even looking at what the contribution margins are and things like that.
Yep.
Which are critical to really analyzing what is the cost of doing business.
For sure. It's these numbers are on the paper. What do they mean? What can I learn?
Right, and then what's cyclical, what is not.
Yep.
What could be an anomaly. And there were challenges doing comparisons between the COVID years.
Yeah.
Right, so you had to kind of take out 2020 and parts of 21, and then do a look back at 22 versus 19 and 18,
Right. Well,
to really get an idea or a measurement of what was happening.
For sure, and it feels like there's always something, right? Because after COVID, then supply chains took a hit, and then now supply chains are coming back. Interest rates started going up, and so it really is important to not just look at numbers on a paper and say, oh, hey, you're not as profitable as you were in 2020. Well, if you're selling PPE equipment, I'm sure you're not, and
Right.
But that would be unreasonable to think that you should be, and so I think that's a great point.
Right. So some people have the habit of managing their financials by looking at their cash and checking accounts on a balance sheet.
Yep.
And looking at that bank balance and saying, we're all
Right.
good.
I'm up.
I'm good. I'm
Yeah.
good. Right. And that's really not how you manage by financials.
Right. That's the outcome of a bunch of different different transactions that have taken place and a bunch of different decisions that were made, and doesn't really, in my opinion, indicate financial health or not.
It doesn't.
It's always positive to see the cash balance increasing, right? Like that's a good spot to start, but that's not necessarily
That's not an
indication.
indicative of the true financial
Yeah.
health or wellness of an
Right.
organization.
Right. Speaking of cash flow, right? That's a great segue into the next financial statement, which to me is maybe the one that's most often breezed over, because it's not as easy to understand as the balance sheet and the profit and loss, and maybe your changes in equity. The cash flow.
The cash flow is difficult sometimes for people to understand, or don't find it of value, but it's of tremendous value. It's broken out in 3 different areas: operating activities, investing activities, and financing activities. And unfortunately, in our industry, the presentation is not always the same, right? There's some diversity in practice. So the standards are trying to get that more cohesive in reporting. And particularly during COVID, there were issues, well, where do we put the PPP and the EIDL loans and all these new CARE Act funding sources?
Yep.
Do they sit down in financing? Do they go up to operating? How do we treat them? So in operating activities, you generally see that's cash that's generated or it's used in the core business operations, right? Above that, you'll have non-cash things such as amortization and depreciation. But in cash, it's really the difference of some balance sheet transactions, right? The difference year over year between accounts payable, receivable, liabilities, deferred revenue, those types of things.
And this goes back to your earlier comment about saying, oh, hey, my cash increased, and it's, hey, this top chunk is what did my operating Monday to Friday business generate cash-wise?
Right.
Hey, if it's a positive number, great start. That means you're overall, generally speaking, the business generated some net cash come the end of the year.
Correct.
And then to your point, then it's, well, hey, did you do anything else with that cash, or did you get it from anywhere else? Did you, right? Moving down to the investing activities.
Right. So that's going to be cash that's used or generated from investment in assets. So say you purchase new assets, right?
Yep.
If you had made some investments or sold some investments and things of that nature and represent you had gains and revenue reflected from that. So that section is how do you use that cash? Are you reinvesting it back into the business?
Right. It's not core Monday to Friday business, but this is where you bought that new piece of equipment.
Right.
Yep, that's a big cash outflow. But that's not a Monday to Friday kind of
No.
everyday business decision. That's this is a big expenditure to allow us for future growth. And
Right.
so, and then the next section, financing, is how'd you pay for some of these things?
Right, and that's where you capture the difference in transactions between either officers, shareholders, LLC members, et cetera, and banks or third-party lenders.
Yep.
In that area.
Right, and looking at the three sections of the cash flow. To me, each one really paints a bit of a different picture.
They
right?
do.
Right. If it's, hey, operating, love to see positive operating cash flow because that means my business is generating cash. Investing, I don't really mind seeing and using cash in my investing activities because maybe that's indicative of big material fixed asset purchases.
Correct. They're reinvesting back into the business.
Right.
So you're not opposed to seeing that. Those are smart types of expenses that are being paid.
Exactly, and then that last section, the financing. Hey, if there's a way to acquire equipment with debt, maybe you see it here. If there's a way to get operating lines of credits, you see it here. If we're paying distributions, you see them here.
Repurchase of stock, things like that.
And this is where your comment earlier that we've seen the business owners who focus on the checkbook balance. If it went down, that's not necessarily a bad thing, right?
No.
It's important to really understand where that cash came from and went. And that's what the cash flow statement says.
I find in my experience over the years presenting the financial statements, the cash flow statement's like the stepchild.
Yep.
It doesn't get...
It's
there, but it doesn't quite get the emphasis of matter that the other two financials bring to it.
Right. And to me, I think that's because it's easy to understand what a balance sheet says, right? That's a snapshot of what I've got at a date, my P&L. Well, that's how my business did this year. Oh, my cash flow, you're taking those kind of the P&L and you're taking my balance sheet and you're mixing them together and there's certain transactions that are specifically identified on there, all to describe how my cash balance changed. That's one line on the face of my balance sheet, and I've got a whole statement to describe what happened in it this year.
And it's really important when you look at your statement of cash flow starts with your net income or loss.
Yep.
Right? And the end result is you're tying what's my ending account balance, right?
Yep.
So it's tying in those two other financial statements.
Right.
And then if it's explained properly, then you really understand how important that statement of cash flows is.
Exactly. I mean, cash is king, right? That's why it's got its own statement.
Correct.
And so to me, thinking of financial statements, those are the three big ones, right? And so then it's what do they say? How can I look at them to maybe better understand what they're saying, right? And so the first thing to me is financial statement ratios.
Ratios are everything, particularly in doing reviews and audits. Having those types of financial analytics and ratios are critical to understanding what the numbers mean and what the trends are, right? And what you need to concentrate or focus your efforts on. So there's a couple of key ratios and metrics. So we look at liquidity. Those are current ratio, a quick ratio. Profitability ratios, gross margin, operating margin, net profit margin. Leverage ratios, debt to equity ratio, interest coverage ratio, and then efficiency ratios, inventory turnover, accounts receivable turnover.
Yep.
So those are a lot of ratios that we use when we are, performing review engagements and also with audits, because it tells a story.
For sure. And to me, the nice thing is they're consistent, right? Like there's only one way to calculate my quick ratio. And
Correct.
so I can look at 10 different companies across a wide spectrum of industries, apply these same ratios, and it gives a consistent output, right? Like I know what the output is.
Correct.
Now, what that number means is a different story, right? How that quick ratio or how any of the ratios compares to industry competitors,
That's a totally different thing.
Understanding that piece is maybe the next level of dissecting the financial statements and understanding performance and KPIs.
Right. Because if you look at if a company takes their performance metrics and their ratios and then compare it to others in their industry, that can gauge for them where they stand among their competitors.
Right. You mentioned a bunch of the profitability ratios. I think that to me is the one that's most easily comparable across competitors in an industry.
Absolutely.
And there's maybe guardrails on both sides. If you're double, triple ratios what the competitor is, that maybe sends up some red flags that I'm not so sure that the underlying reporting is consistent. But hey, if you're under the average and the figures are calculated in a similar manner, maybe there's an indication of there's opportunities for efficiencies, or there's something your competitors are doing that you're not. And similarly, the other way, if you can find some additional opportunities to gain efficiencies, maybe you see your ratios a touch above the competition.
And you see it heavily used in franchises. For like a master franchisor, they take that information, the data. All of the franchisees use the same chart of accounts. So all the financial statements line up the same. So when they do the ratios, they can quickly say, why is this one underperforming?
Right.
Why is this one overperforming? And they have a really good comparison among that particular type.
And to me, that's maybe where franchisors stand alone, is they're able to have the wider data set of information, and they can really leverage it to say, hey, your competitor 2 towns over are doing things a bit differently. They're open different hours. They're focused with their marketing efforts in a different spot than you are, and here's what they're getting as a result of it. It's just franchisors are in a unique spot to allow their franchisees to leverage each other in a friendly marketplace.
Right. And nonprofits, different types of nonprofits depending upon their type of service model or what they do, their ratios are going to be different than another nonprofit.
For sure. And I mean, nonprofit, as going back to comparability of the data set, right? Nonprofits are totally different ballgame. So, hey, even if there's, a nonprofit medical institution, I don't know that's not necessarily a fair comparison if you're a for-profit hospital.
Absolutely.
Right? The objectives are different.
Totally different.
The key sources of revenue sometimes are different.
Totally different.
And so it really is important to understand, A, what you're looking at, and then B, why the comparison makes sense or doesn't.
And this is what financial institutions look at, these ratios, to assess the health of an entity, the ability to repay debt.
Yep.
And that's what they include in their covenants, not their
financial
loan
covenants. Yeah. And to your point, right? Because the numbers kind of boil down to the same, right? So whether it's a large corporation or a smaller corporation, when you're looking at quick ratio and things with how the math works, the ratios, the underlying ratios are comparable, right?
Correct.
So like Coca-Cola's is comparable to a local niche soda bottler.
Right, because they're taking the same line items
Right.
to get to that ratio.
Right, which is why financial institutions are able to drill down with expectations for what these ratios should be. And hey, your company doubles in size, that doesn't move the needle on what maybe the underlying ratio should be. It's
Correct.
not like, oh, hey, I'm twice as big. My quick ratio, which is my ability to pay my current debts, that doesn't necessarily double.
Right.
As your debts go up, your assets go up. you would
Correct.
expect in a similar fashion, which is what makes these, to me, what makes the ratios more important.
They're critical.
Yeah.
To really understanding what goes on, they're critical.
For sure.
Right. So footnotes are critical. They tell the story. They open with a generic explanation of what the company was, why it was founded, when it was founded, and what they do. Right. Very concisely.
Yep.
Then it takes you through what are the significant accounting policies. How do they report revenue? You know, where are the performance obligations, or how do they recognize it? And all sorts of different things in there to lead the reader through. How do they handle accounts receivable? Right? How do they handle debt? How much debt is there?
Yeah. Right. Where is it? When's it due? It really is the narrative. I mean, you know, if you put the financial statements, if you put some of the numbers aside and all you had were the footnotes, to me, there's just as much to be learned about the company than what the numbers would say themselves.
Absolutely. It's a good narrative summary, and it has some numbers in it, but it's not, you know, the financial statement. It supports the financial statements. Right. And it even speaks to what happens in a subsequent event. So your year end closes December 31st, but those disclosures still contain information about post 12/31.
Right. Which is maybe an important takeaway, right? We've talked a couple times about the balance sheets, that picture in time. What happens if, God forbid, the building burns down January 5th? You don't know that. The balance sheet, it's still on there, it still looks good, but hey, subsequent event, there was something catastrophic, and the business doesn't operate like it did on our balance sheet date.
Or you take something that was global,
yep,
like in COVID, and we had to create narratives and disclosures that were never seen before.
Right. 2019 finished just fine.
2019 finished fine. 2020, there's a giant, we don't know what's going to happen or how this is going to be impacted. Wait and see.
Right. And especially thinking about like operating type businesses where, you know, event centers, entertainment centers, hotels, when those statements are being issued in March and April of 2020, they're shuttered. And they, some of them didn't open for another 12 months.
Exactly.
Right. So it really is, hey, 2019 was a fine year, right? We operated, the economy was booming, but we're closed and we don't know what the future has to bring. Talk about uncertainty.
Right. So a lot of uncertainty, and it spoke to certain industries. So if you were in, hospitality, entertainment, they took a especially even harder hit.
Yep.
Because of certain restrictions. Yeah. And then there were certain funding that was available to them that has to be disclosed because they have obligations that could go on for 30 years based upon some of the CARES funding.
Yep. Yeah, and it's, hey, if all I gave you was the balance sheet, P&L, and cash flow, you'd say, oh, this hotel's doing great.
You wouldn't know.
Nothing to see. You wouldn't know.
You wouldn't know, but a lot of those businesses got propped up by PPP money and idle money.
Right. I mean, if not, I could imagine how many wouldn't be here today, right? So it's, it totally makes sense what's happening, but you don't get that from just looking, in this case, at the basic financial statements.
Right. So the disclosures are really important.
For sure. And, and I think thinking about like the key takeaway, context. That
comparisons over time. One of the things when I look at an analytical, I like seeing, an entity, the monthly activity all in one snapshot.
Yep.
So I could see the ebb and flows, and if something's cyclical, if something is unique, it pops out, right? So you really need to look at those trends analysis. They tell a big story. Mm-hmm. Benchmarks against peers, another great thing is particularly if someone's going to buy or sell a business, how do they compare against others in their field? Are they ahead or what do they need to do? More work. And then look at the qualitative factors. So assess management's discussion, the market conditions, and company strategies for a comprehensive view. Do they plan to, they want to grow, how do they plan to do that? Are they dealing with the succession plan?
Yep.
All those things will factor into the future going forward. So the financial statements, the balance sheet is a particular time where they've been.
Yep.
Income statements, what's happened in the year. But then, between the disclosures and then the context, where are they going?
Right. And it's leveraging those ratios. To me, I think your point about benchmarking against peers couldn't be more relevant, more important, because if you have no expectations, right? You talk about analyticals, and I think that's kind of the first thing that comes to us. We start thinking about our reviews, our audits. It's what do we expect? How did we set those expectations? And to me, that's not just something that the CPA puts his hat on and comes in to build the financials. It's you as a business owner, you had expectations for the year. You as evaluating whether you want to purchase and invest in a new business, you have expectations for what that performance should be, and it really is important to keep that context in mind.
It's like any individual with goal setting.
Yep.
What's your SMART goals? What are your goals? And then you measure them. Are you achieving them or not? It's the same thing with applying the financial statements.
Right. Otherwise, they're just numbers on a paper.
It's just numbers on the paper, and you're just going through, and it's the checkbook management style. Unless you really take those numbers and the metrics and the ratios into play to really plan the future, what you want to do and how you want to accomplish. So if you want to sell your business in 5 years, well, then you need to start doing the legwork now, and that's why you need to utilize.
Manage to that.
You manage to that.
For sure. And June, I mean, to me, I think that's kind of the key takeaway. I think that's kind of puts a nice one sentence bow on the financial statements, right? That they're numbers on a paper without that context.
Correct.
And so, I think with that brings us to the end of another episode of Wilkin Gut and Plans, the Balance Sheet Breakdown. I'm Chris Frederick, where we help you make sense of the numbers.